The weakest American borrowers are starting to miss payments and default on their loans, and that's showing up in an unexpected place. Joining us now, CNBC.com banking reporter Hugh Sun, and his latest article just out this morning is titled "Goldman's Apple Card Business Has a Surprising Subprime Problem." Tell us about it, Hugh.
Hey, Joe. Yeah, I mean, look, it's a bit surprising. If you were to talk about Goldman Sachs and Apple Card, you might assume that they would focus on a higher end, end user. And, that's not the case. We took a look at their portfolio. Fully 28% of their users of their loans go to users with lower than 660 FICO scores. That's near prime and subprime. We're beginning to see, after this period of really pristine consumer credit, we're beginning to see people fall behind on their payments. We're beginning to see people actually, lead into losses. That's when you don't pay for 6 months, it becomes a charge-off. We're starting to see that appear at some of the newer entrants in the credit card industry, and that's being Goldman Sachs.
So how's this work, Hugh, in terms of as it slowly makes its way? How far will it make its way in terms of lenders, do you think? This is like a canary in the coal mine. Does it become more widespread, do you think? In other words, are we headed for a sharper slowdown?
So it's really early in the process. So like I said, we just had basically a pristine credit, environment, the likes of which, these credit card companies have really never seen in decades. And where you saw, repayment rates that were, really, really high because people, they got money sent to them, right? Obviously, they got the pandemic stimulus checks, and that fattened up their balance sheet. So we're kind of working off of that. And so the question remains is, Goldman Sachs has built this really new, nascent consumer business, and they're growing really rapidly, and they've really scaled up in consumer retail. And if you ask them, they're doing the right thing, and they're comfortable with all the risks they're taking, and they're examining, their portfolio and understanding that, because it's only a 2-year average on their users, that, some of those delinquencies should lower over time, as their book of business gets aged and seasoned. But, at the same time, if they're scaling up in a business ahead of a potential economic downturn, what's that going to look like? And, we know that already, management has said back in 2020, look, we're going to break even in consumer business by 2022. And as it happens, this year they're projected to lose over $1 billion in their consumer business, mostly because they're plowing money into these credit card reserves. So we're seeing that, that certainly it's fair to say that they put more money into this business than, when they started this journey, than they thought they would.
Is that just a question of timing, Hugh? Just in terms of a recession potentially coming?
I mean, it's the question of how bad does the economy get, and whether or not the weakest American borrowers get stressed and pushed to the edge of default. You have people who are living paycheck to paycheck, and at the end of the month, they're making these triage decisions about whether or not they're going to pay off their Apple Card, whether or not they're going to pay for groceries or gas or anything like that, and they're going to actually remain solvent on their other credit. I mean, certainly timing is a big part of this, but you could argue that Goldman Sachs is pursuing the correct strategy. I mean, clearly they need to diversify away from the Wall Street businesses, but are they going to be a victim of poor timing, I think, is the question.
Hugh, thank you.